Involuntary conversions. You hate to see it. This is something that comes up in a few other lessons as well. We just want to touch upon it here. There's just a lot of overlap, but hey, these are important topics to know, so it doesn't hurt that you're seeing it again. Involuntary conversions refer to situations where a taxpayer's property is destroyed, stolen, or taken away by those damn government authorities through condemnation or eminent domain. Condemnation, say the government comes by, the health and safety board, they say, oh, this house is going to fall apart, you have to get out, or there's poison or rat droppings or something like that. Eminent domain, they say, we need you to buy your house and destroy it so we can build a super mega highway. Touch upon that in another lesson as well. In such cases, the property owner may be entitled to compensation, and the tax treatment of the compensation received is governed by specific rules under the IRC in the United States. What are the effects of this? Whether your house is burned down, you get insurance proceeds, it's taken away, any of these conversions, you're converting your property to hopefully cash, hopefully you're getting money for that, and it's involuntary. You're not choosing to do this. Now, the tax treatment here depends on whether the compensation received is reinvested. So the government takes your property away, gives you the fair market value of it. They condemn it. They pay you for it. Your insurance gives you money. Hopefully you have insurance if your property is destroyed, stolen, or taken away. So that's what we're going to see here. What's the tax treatment of that compensation received? Now, if you reinvest it in a similar or like-kind property, which is referred to as a replacement property, generally you're not going to have to worry about tax. Kind of like the IRS saying, hey, you went through enough trouble as it is. If you take the money you received and reinvest it in a new house, then you're good. You'll only pay tax on any excess of the money you didn't use to reinvest in the house. But let's see the rules here. So we have gain or loss recognition. If the taxpayer does not reinvest the compensation, let's say your house burns down, you get $1 million from insurance, and you just say, I'm moving over to Guatemala. I'm going to just live my life there. I'm done living where I am now. So if you don't reinvest that in a replacement property, they must recognize the gain or loss in the conversion. The gain or loss is calculated as the difference between the amount received, so generally probably your insurance payout, and the adjusted basis of the property that was involuntarily converted, if it burnt down or something. Deferral of gain, if the taxpayer reinvests the compensation received in a replacement property within a specified time frame, they may defer the recognition of the gain. This is going to be known as a 1033 election. The basis of the new property will be adjusted to reflect the deferred gain. And then losses, let's say the insurance proceeds don't cover the basis of the property. If the taxpayer experiences a loss from the involuntary conversion and doesn't reinvest the compensation, they may recognize the loss and deduct it from their taxable income. We got a great example here for involuntary conversions. Suppose a taxpayer owns a rental property with an adjusted basis of $200,000. Unfortunately, due to a natural disaster, the property is destroyed and the taxpayer receives some insurance payout of $300,000. Now, if the taxpayer does not reinvest the compensation, they must recognize a gain of $100,000. It's kind of like you sold it, right? It's the same treatment as if you sold it for $300,000, got that money. However, if the taxpayer reinvests the entire $300,000 compensation in a similar rental property within a specified time frame, you can't just wait years and years, you can defer the recognition of the $100,000 gain. The basis of the new property will be $200,000, which is the original basis of the destroyed property. The deferred gain will be recognized only when the replacement property is sold or disposed of in the future. Compensation for vacating rental accommodations, similar sort of situation with involuntary conversions. Let's say a taxpayer lived in a condominium and had a 3-year lease that began 20 months ago. The taxpayer's landlord wanted to convert the building to a hotel and offered the taxpayer $15,000 to vacate the condominium immediately. All right, maybe a pretty sweet deal. The taxpayer's lease on the condominium was a capital asset but had no tax basis. If the taxpayer accepted the landlord's offer, get the heck out of there so they can destroy the building, build something else, the gain or loss would be what? Well, a capital asset which is sold or exchanged more than 1 year is going to be a long-term capital gain or a long-term capital loss. Now, in this question, the leasehold interest, which is a capital asset, was acquired more than a year ago, and there's no basis, it's zero. So in this case, you're getting $15,000, it's a gain. You would recognize a long-term capital gain of $15,000. And let's see, capital losses from an S-Corp. Obviously, we have lessons on S-Corps, but you will be receiving income from that. All these lessons are intertwined because the individuals own the S-Corp. You got to understand how income is recognized at the individual level from these. We got Smith, an individual, owns 100% of Grove, an S-Corp. At the start of the year, Smith's basis in Grove was $30,000. Grove had ordinary income during the year, amounting to $12,000, and a long-term capital loss of $5,000. Smith has no other capital gains or losses during the year. What amount of the long-term capital loss may Smith deduct this year? Well, Smith's total loss was $5,000, and we normally could do that. However, remembering our rules, not letting them fall to the wayside, we do have a $3,000 annual limit on capital losses, so we can only deduct $3,000. We'd carry forward the remaining $2,000 to future years. Always trying to trick you. Well, that's the exam. We're tricking you here to make you prepared for the exam. If I had my way, we wouldn't trick you. It would be straightforward, but that's the way they love to make the exam. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.